Welcome to This Explainer. Today we're diving deep into a due diligence evaluation of HA Sustainable Infrastructure Capital, or as you probably know it by its ticker, HASI. If you're an investor trying to figure out exactly how to align your portfolio with the multi-trillion-dollar energy transition and doing it without sacrificing robust, predictable fundamentals, well, you're in the exact right place. We're going to look under the hood and really see what makes this vehicle tick.
Let's just start right off the bat with the massive macro opportunity here. Analysts are forecasting a staggering $4 trillion need for U.S. sustainable infrastructure investment between 2025 and 2050. $4 trillion. To put that number into perspective, we're talking about a multi-decade runway that's going to require hundreds of billions in capital deployment every single year. This isn't just a trend, it's a massive structural shift in exactly how we power our economy.
So the crucial question for institutions and retail investors alike is, how do you actually capture this incredible value reliably? Like, you obviously want to participate in this massive multi-trillion-dollar wave, but how do you do it without sacrificing financial returns? And just as importantly, how do you avoid falling victim to corporate greenwashing? Because you really need a partner with a battle-tested track record and real measurable impact, not just a good PR team.
So here's our roadmap. First, the climate investment opportunity. Second, ASI's diversified portfolio strategy. Third, financials, yields, and returns. Fourth, strategic partnerships as a moat. Fifth, verifying impact with carbon count. And finally, pipeline and future outlook.
Section 1. The Climate Investment Opportunity.
The macro environment right now is practically a perfect storm for sustainable infrastructure. Just think about the explosive growth of AI and the massive data centers required to run it. I mean, they are completely rewriting U.S. power demand forecasts literally as we speak. Couple that with a major resurgence in domestic manufacturing and the widespread of electrification of both transportation and industry, and you've got an urgent, undeniable need. It's really no longer just about replacing legacy coal plants to be green, it's about meeting a massive new capacity shortfall. These sectors desperately need clean energy assets that provide long-term, highly predictable power and cash flows.
Moving to Section 2. HASI's Diversified Portfolio Strategy.
To actually capitalize on this demand, HASI manages $16.4 billion in assets, and they are heavily weighted at 60% toward behind-the-meter projects. For investors, behind-the-meter basically means decentralized, localized assets. Think rooftop solar, battery storage, and major energy efficiency upgrades for commercial buildings. These projects offer incredibly sticky revenue because they serve the end user directly. Then, another 29% of the portfolio targets grid-connected utility-scale solar and wind, and a further 7% focuses on fuels, transport, and nature, like renewable natural gas facilities. This very deliberate diversification is what insulates the overall portfolio from localized regulatory shifts or sudden technological shocks.
Now, to optimize growth and flexibility within this diversified approach, management made a super strategic structural move. Effective January 1st, 2024, HSI transitioned away from being a real estate investment trust, or REIT, and became a taxable C corporation. So why does this actually matter for your wallet? Well, a REIT is legally required to distribute nearly all of its taxable income as dividends, which constantly forces a company to issue new shares to raise capital for new projects. By becoming a C corp, HSI gets to retain way more of its earnings. For you as an investor, this means less share dilution and a much more self-sustaining internal growth engine.
Let's jump into Section 3, Financials, Yields, and Returns.
Because ultimately, right, a sustainable mission absolutely needs sustainable margins. Let's look at the stark contrast in cumulative total returns over a 5-year period here. The broader clean energy sector, represented by peer indices like the ALPS ETF, has faced some pretty severe drawdowns and intense volatility lately. But when you plot them side by side, HASI's performance trajectory demonstrates vastly superior resilience and outperformance compared to its direct clean energy peers. They've really managed to weather sector-wide headwinds by focusing heavily on fundamentals rather than just speculative growth.
And that resilience is driven directly by their underlying asset performance. Analysts project a really steady upward trajectory for both adjusted earnings per share and dividends per share straight through to the end of the decade. In a macro environment where the rising cost of capital has been a massive headwind for clean energy, securing new portfolio assets that consistently yield above 10.5% is a huge differentiator. HASI is locking in these high-yield, long-term contracts that provide incredible visibility into their future earnings power.
Furthermore, their balance sheet is really fortified to protect those yields. Their debt-to-equity ratio currently sits at approximately 1.6 times. That is safely within their board-approved target range of 1.5 to 2.0 times, which shows some highly prudent leverage.
In the world of infrastructure investing, avoiding overextension is exactly how you survive vicious market cycles. This 1.6 times ratio gives their balance sheet incredible defensive strength, making sure they can still fund rapid growth without, betting the farm.
All right, Section 4, Strategic Partnerships as a Moat.
We really need to understand that HASI isn't just some transactional lender. Their programmatic strategic partnerships form a very deep and highly defensive competitive moat. Just look at the sheer caliber of these alliances. When a global investment heavyweight like KKR enters a $2 billion joint venture with you, that signals massive institutional validation. They also recently closed a $207 million financing deal with Vision RNG and a $500 million joint venture with Sunrun. For any retail or institutional investor watching from the outside, this is the smart money overwhelmingly validating HASI's rigorous underwriting capabilities.
But it's not just about handing over massive checks. As Vision RNG's CFO points out right here, HASI provides complex, tailored solutions, things like construction facilities and specialized investment tax credit bridge loans. They act as proactive, strategic problem solvers for these operators. This hands-on, partner-centric approach actually accelerates the deployment of clean fuels, and honestly, it makes HASI the absolute preferred partner for future projects. This deeply ingrains them in the industry and effectively locks out competing lenders. Moving on to Section 5, Verifying Impact with Carbon Count.
Now, investors increasingly, and I'd say rightfully, demand actual proof that their capital is actively helping the climate. So many funds out there simply slap an ESG label on their portfolios without any hard math to back it up. But HASI's proprietary carbon count tool solves this by creating a rigorous mathematical baseline. It evaluates real assets to determine exactly how much CO2 is avoided per single dollar invested. It transparently ensures that absolutely every investment HASI makes is neutral to negative on incremental carbon emissions. So it gives you, the investor, undeniable, auditable proof of your environmental impact right alongside your financial yield.
Finally, let's look at Section 6, Pipeline and Future Outlook. Management has confidently reaffirmed their long-term targets, guiding for an 8 to 10% compound annual growth rate for adjusted EPS through 2027. Look, in the utility and infrastructure space, high single-digit growth combined with a high-yield dividend is an incredibly powerful total return engine. They're also optimizing their dividend payout ratio to a healthier 55 to 60% just so they can retain more cash to fuel that exact growth. And this isn't just hopeful guessing either. It's backed by a highly visible 12-month pipeline exceeding $6.5 billion in stringently vetted asset opportunities.
We've seen the undeniable macro demand driving this sector, the resilient margins that are consistently outperforming peers, and that expanding moat of deep institutional partnerships. So, as you look to deploy capital into the multi-trillion-dollar energy transition ahead, the question isn't just whether you should invest in climate solutions. It's really, with a $6.5 billion pipeline, is HASI the climate solutions partner your portfolio needs? Thank you so much for joining me for this explainer, and I really hope this deep dive helps you make a thoroughly informed strategic investment decision.